This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. Thank you for joining us. This one, Grain Farm Returns for 2021 and 2022. It's put together by Gary Schnitkey, Nick Paulson, and Dale Lattz, along with Bob Rhea. Bob is not here today. However, we will talk with the other three folks. And the topics for the day will include grain farm income outlook, prices and costs outlook for 2022, the cash rents and variable cash rent leases. We'll begin with ag economist Nick Paulson today. He's going to talk about grain farm income. Thank you, Nick, for being with us. We'll get started right away. And remember that if you are going to ask questions, you can do that in the question box and go ahead and put them in. I do want to make sure that we thank our sponsors for the day as well. They include TIAA, the Center for Farmland Research, Compeer Financial, Corteva Agrosciences, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers, and the Illinois Soybean Association. Let's take a quick poll as we start. What do you expect corn prices to average for the 2022 crop year? So go ahead and put that down. We'll get started with that poll to begin with. Below $4, between $4 and $4.50, $4.50 to $5, $5 to $5.50, and over $5.50. If you can fill out the poll. About the time we get to 70 or 75% of you who have filled that out, we'll give you the answer. We're awfully close. There we are. We just passed 70%. Poll numbers are still rising. We'll let you vote for a second. And there's your answer. 37% say $4 to $4.50, and 49%, nearly half of you, think the price will be between $4.50 and $5. That will be the average price for the 2022 corn crop, or the one that we'll put in the ground next spring. Now, let's turn our attention to grain farm income, and we will talk about some of these topics, including that outlook. Nick Paulson is here. Good morning to you, Nick. Thank you so much for being with us today.
All right, thanks, Todd. Thanks as usual for the introduction and getting us kicked off this morning. So first thing we'll take a look at here is a look back to the mid 90s in terms of the average net income on grain farms that are part of the Illinois Farm Business Farm Management Association. So these are Illinois grain farms, members of FBFM, and we can see that in the late 90s through about the mid 2000s, we had farm incomes fluctuating kind of around that $50,000 to $60,000 level, and then the increase in farm incomes that we experienced with higher prices thanks to higher demand for corn from ethanol, as well as growth in export markets for soybeans, with a high income of almost $300,000 per farm in 2012. Then following that, we had some lower commodity prices, some lower income years, kind of a return to some of those lower incomes we experienced in the late 90s and early 2000s. But in recent years, particularly in 2020 and even in 2019, we had higher income level, 2019, 2018, higher income levels, thanks in large part to bigger government payments from some of the ad hoc programs such as MFP in 18 and 19, CFAP in 2020, along with some of the other pandemic support programs that provided some extra income in this most recent year. So 2020 in general was a pretty good income year in Illinois for grain farms, over $250,000 in income on average. Still not as high as what we saw in 2012, but a good income year. Looking ahead to 2021, putting an exact number on that, I don't know if we're willing to do that at this point, but probably something lower than what we saw in 2020. So even though we're looking at continued strong prices through 2021, good yields in 2021, not the level of government support that we saw in 2020. So probably a similar to slightly lower income year for 2021. So, what do farm businesses tend to use that income for? Well, one of the things that we track closely is family living expenditures. So if we want to take a look at that over a similar time frame, last 20 years going back to 2000, we can see kind of a gradual increase during the higher income years in family living, kind of a stable to slightly declining level of family living during the lower prices from 2014 through 2017, and then pretty much stable. And in 2020, despite the high income, a slight decrease in family living relative to 2019. So I think the explanation we jump to on that one is there's probably a lot of uncertainty in 2020 associated with the pandemic. The government support that was provided, that was a big component of that farm income in 2020. A lot of that wasn't necessarily known, and so I think there was a lot of conservative choices in terms of family living expenditures, and just probably a limit on some of the things that people usually do. None of us are probably traveling as much as we used to, and doing some of those things that would fall in that family living category. Other use of income would be capital purchases, and that follows a pattern that more closely matches income trends. So we see a consistent increase in capital purchases during the high income period, a reduction in those when we had lower incomes with lower commodity prices, and then increase in recent years with the higher income levels that we've had. So again, this is all kind of what we would expect. High incomes are used to reinvest back into the business, in addition to financing some of those personal expenses. Getting past just kind of the income picture, looking at where farms stand in terms of liquidity. So here we're kind of looking at the current ratio along with income over time. You can see that, again, as we'd expect, increase in the liquidity position during that period of rising farm incomes, a decline in liquidity as incomes fell, and then a general improvement over the last few years, but still not back to an average liquidity position that we saw in 2012, but still overall a pretty solid current ratio in that 2 to 2.5, closer to that 2.5 level on average for farms in Illinois. So one thing we do like to caveat that with, it is a relatively strong liquidity position, but there is a lot of sensitivity in that, particularly based on how the current assets are composed on grain farms. So here, about 60% of the current assets is tied up in grain inventories. And so that value is obviously very sensitive to any fluctuations that we would see in commodity prices. So, just over a third of it is in cash and equivalents and other current assets that would probably hold their value relatively well, versus that grain inventory piece, which again is quite sensitive to current prices. Moving on to the solvency side of things. So we've seen a general improvement in the solvency position for farms going back to the early 90s. So a pretty dramatic decline to, I guess, the best average solvency position we've seen in 2012 with a debt to asset ratio of 18%. Since 2012, kind of an increase, again, associated with those lower income levels that we've seen, but still overall debt to asset ratios that are still in a pretty comfortable range here on average, and pretty stable over the last few years, with a slight decline from 2019 to 2020, with the current average of 21%. Again, thinking about kind of things that affect that solvency position, on the asset side, the majority of that is going to be tied up in fixed assets. And so that the majority of fixed assets here would be in farmland or farm real estate. And again, our debt to asset ratio or our solvency position would be relatively sensitive to any fluctuations we might see in land values, just like the liquidity position is pretty sensitive to commodity price fluctuations affecting that inventory level. And then the last point on the debt to asset ratio, again, overall, we're in a strong position, but there is a lot of variation around that mean. And one of the things that really is associated with the debt to asset ratio for any given operation is the age of the operator. So this really reflects, I think, a pretty natural business cycle. Younger farmers tend to have to carry more debt to finance their operations, just given the very capital intensive nature agriculture and grain production more specifically. And so we see those younger operators in a much more highly leveraged position, still not necessarily in a range that would be considered extremely problematic, but one that would be more sensitive to fluctuations in prices and income levels relative to those older operators that have much stronger balance sheets in terms of the capital structure of their operations. So with that, I think I'll turn it over to Gary, and he'll talk about price and cost outlook going into 2022.
All right, thank you, Nick. And as Nick said, we are looking and projecting a good year for 2021. In general, about the same or maybe a little lower levels than 2020, but still a good income year. So now let's turn our attention to 2022 and what we expect to see here. So we're going to start here with market year average prices, or looking at the price side. And what I'm showing here is corn and soybeans over time. This is a market year average price. USDA is projecting for the 2021 marketing year, which began in September and will end in August for both corn and soybeans here, a $5.45 price for corn and $12.90 price for soybeans. So both of those are well above what we have experienced in recent years, and is part of the reason, or much of the reason, why we're looking at higher incomes in 2021. And now turning to our expectations to 2022, I think it's pretty important to think about what commodity prices look like. And there are distinct periods to commodity prices. And here we're looking from the period from 1973 to 2005. What we saw was generally prices for both corn and soybeans varied, but did not trend up or down. During that period from 75 through 2005, corn prices averaged $2.38. And again, there were periods above that, long periods where it was below that. 1995 being a high period, and then we were below it to 2006. Soybeans averaged $5.98 or $6, and from during that period, and again had higher prices than that $6 and lower prices than that $6. We reached a new higher plateau in that 2006, 2007, 2008 period. And a lot of that higher plateau was because of continued strong demand for soybeans in exports, but also because of the ethanol build. Corn was used for producing ethanol. That ethanol build, corn use in ethanol is still very important, but the build of that use sort of climaxed in the 2012-2013 period. But since that has occurred, we've had $4.38 has been the average price for corn, and $10.63 for soybeans. Both of those $5.45 and $12.90 price for corn and soybeans for 2021 are above the $4.38 and $10.63. And we would expect those prices over time to come back down and be below that $4.38, sometimes $10.63. But our belief, I suppose, is that $5.45 and $12.90 isn't a new long run average, but we're going to come back down at some point when Brazil has a large crop, U.S. has a large crop, and when that happens is anybody's guess. But we're using for 2022 right now $4.50 for corn and $12 for soybeans. I would note that $4.50 for corn, what we're using for 2022 projections, is below forward bids for 2022 crop, which is now near $5, and that $12 for soybeans is pretty close to what forward bids are. Those things are built on use, and the thing that has happened in 2020 and 2021 that have caused our higher prices is increases in use. And for both corn and soybeans, that increase in use has been in exports. So, and again, food, alcohol, and industrial uses have sort of reached a stable level, feed and residual as well. and exports have grown in recent years, and for 2020, those are at record levels. So where our prices go now for both corn and soybeans are largely dictated by exports and the supply situation. But those exports, Chinese demand for a large amount of these crops and other demands as well, but have buoyed up our prices. We continue to see export demand for soybeans continue from the United States. Export demand are at over 50% of the crop, and we would expect those to grow. And again, those exports, a lot of those are driven by what's happening in China and continued growth in livestock demand for feeds in China. And that's going to be, until for the foreseeable future, what drives the demand side for our crops. So if we're looking at 2022, we're still saying that those prices will be above those 438 and 1038 averages, but probably coming back down towards those averages. And again, the supply situation in both Brazil, what crops do in Brazil, and here then in the United States will have an impact on those price levels. Going into 2022, though, one of the certain things that we'll see is that our non-land costs are going to increase. So this would be fertilizer, seed, chemicals, machinery cost. It's difficult to find a cost that is going to be down in 2022, with the possible exception of interest cost, and those would be down because of lower debt levels, not because of lower interest rates. Dale's shaking his head that those interest costs are going up. So he even disagrees with that. All the costs are going up. And we're going to look at record level of non-land cost in 2022. We're projecting those at 677. That projection was made in September. We're probably going to be increasing those costs as we move forward. Again, all costs have gone up. Machinery costs, the list prices of machinery have gone up. Seed costs are going up 8 to 10%. And all costs are going up. One of the ones that we're really focusing on now are fertilizer cost. And the last reading we have of anhydrous ammonia is $856. That's an October price, and $856. And those anhydrous ammonia costs and all nitrogen costs have been going up primarily since last year. About this time, have been on a increasing trend, and they've been really going up this fall. We've seen that increase to $856 again. That's a $50 jump from the September average. DAP $781, and $725. So to give you a feel, we had $150 budgeted for corn cost, fertilizer cost in 2021 or this year, and we're now looking at that cost being closer to $200 for 2022. So fertilizer costs there are going up about $50 per acre, based on the prices that we've seen now. So we have a poll question for you. So anhydrous ammonia currently are $850 per ton. What do you think they'll be in the spring? So, and we do have that question, but we're going to ask you that first. You tell us what you think it's going to do, and then we'll say what we think. All right. So and as you're voting on this, please continue to vote. There's a couple of factors that are influencing higher anhydrous ammonia prices. Some of those are related to the energy sector, which has been, we've seen natural gas and all energy prices increase, and anhydrous ammonia and fertilizer prices also have a linkage to corn and soybean prices. The polling results here, a few of you think it's going to be below $70 per ton. Most of you are thinking it's over 800 to 900, 41%. 36% are up to 900 to 1,000, and then 9% of you think it's going to be over 1,000. Just to put some context about this is the anhydrous ammonia prices that we've seen from 2008 to the present. This is the price of in Illinois, as we're looking at the price for anhydrous ammonia in Illinois. Anhydrous ammonia, one of its major ingredients are natural gas. And natural gas prices and anhydrous ammonia are correlated. They have a 0.4, little over 0.4 correlation. And in recent times, in the latter part of 2021, we've seen those natural gas prices increase, and that can obviously have some impact on then anhydrous ammonia prices. So we've seen those natural gas prices go up. There's a lot of speculation about why those are going up. The energy sector, we've seen all of the energy sector prices going up. A lot of that is related to COVID and getting the supply system running again. Some of that is policy induced, and there's a number of items that are influencing that. So that is the relationship between natural gas. We also see a very strong relation between anhydrous ammonia and corn prices, and that actually is stronger than the natural gas price. So the correlation coefficient between corn and anhydrous ammonia is 0.7, over 0.7. So there's a pretty strong relationship there. So in either one of those prices factors, the corn price or the demand pull and the cost, would suggest that anhydrous ammonia prices are going to continue to increase. So I would be on the higher end of that, or not looking at any price declines into the spring, but things happen in agriculture. This particular one, though, is important for another reason, and that is that is going to have an influence on corn and soybean decisions going into the 2022 year. Still, given the cost budgets that we've increased, we would be saying that operator and land returns, which is revenue minus non-land cost, would still be above our average cash rent moving into 2022. So this is based on above average prices. We have put prices in there for $4.50 for corn and $12 for soybeans. So if we have those prices going into 2022, even given the cost increases, we could see a good income year. It wouldn't be anything like 2020 and 2021, but a good income year. So the thing to note, though, is if we go back to prices below $4 and $10 for soybeans, like we had from 2015 through 2019, we would have very low operator and land returns, and they would be well below those land costs. So our economics is in every year, but this year as well, we're basing that on prices. And given what we've seen on the cost side, we have to have much higher prices in the future than we have in the past to have break-even levels. We're also looking at going into 2022, corn being projected to be less profitable than soybeans. And that's going to differ than our 2021 projections, which have corn more profitable than soybeans. But overall, since that 2013 period, we've seen corn less profitable than soybeans. Again, soybean demand has continued to grow, and corn has not. So there's a pull for more soybean acres. But looking at 2022, we're projecting soybeans to be more profitable than corn. How those economics work out is going to depend a lot on where nitrogen fertilizer prices fall. So that is if those continue to go up, the difference between corn and soybeans will continue to grow as well. I would note that those numbers that we're projecting for 2022
corn.
are in this chart based on a 450 corn price. Right now, you can get $5 forward bids for delivery on corn in 2022. If we put that $5 price, those two prices cost or operator and land returns for those crops are near equal to one another. So there's where we're at. If we're looking, and there's a possibility that we will have below $4 corn and soybean prices below $10. We have a question for you. So if we've seen this in the past, 2018, 2019, and 2020, we saw those years having low prices and we had ad hoc payments, MFPs and CFAP. What do you think would happen if we had below $4 corn and below $10 soybeans in 2022? Would we get another round of ad hoc federal payments? And we're asking you to project on that. So we'll take you as the gospel here about whether those are going to happen or not. But there is considerable thought amongst policy circles in particular that if we have another lower price, we would have another round of ad hoc payments. The MFPs and CFAPs set the precedent for doing that. A lot of you are slower voting on this than you were on the corn prices, but you're almost one more vote. All right, we're done. And here's your vote. 10% of you think yes, definitely. 54% could be. 37% said no way. So 64% of you think that there's a possibility of that. We don't know, but again, if we see those prices below $4 and $10, we would be looking at a poorer negative income outlook. And we're going to move to cash rents here. Do you see, we have one question here we'll answer. Do you see an increase in domestic demand for soybeans with an increase in demand for soy oil for renewable fuels? Nick, you want to take that? Or
Yeah, I don't know. I think that depends on your outlook for the whether there actually will be an increase in demand for soy for renewables. I think there's a lot of uncertainty surrounding how the RFS may continue to be or not be enforced moving forward, or even ways in which that can be changed moving forward, given where we're at now into the RFS legislation. So that's not at all an answer to that question. I just think it's highly uncertain whether there will be that increase in demand for soy associated with renewables. But Gary, I think I think relative to corn, I think there's definitely more optimism there on the domestic use for renewable fuel side for soybeans. And then, continued growth in the export markets, I think, is probably still an area for optimism in soybeans. Would you agree with that?
I would agree with that. And right now, for Illinois farms, everybody looks at China. Does RFS matter? California seems to be demand.
Well, California is a big state, but it's a big country too. So they obviously have an outsized share of total potential demand for motor fuels. But it's I guess the question is, how closely do you think other states may follow California's lead? That's probably the trend I would be concerned with there.
Hey, Gary, can I ask Nick a question too? I'm going to anyway, I suppose. But on the ad hoc payments, because 2022 is mid-session election, will that play a role in whether those payments are made or not?
I'm getting all the easy questions this morning. I don't have the political acumen to provide any expertise on that. I just know that I've consistently been proven wrong about the willingness of Congress to provide support to agriculture when it's arguably needed. So
no one cares about deficits anymore.
Yeah, I mean, if there's anything that's been proven the last 3 years is that spending doesn't seem to be a concern among both parties criticize each other for it, but when it comes down to it, it seems like we're always willing to spend and deficit spend. So I would not be surprised if there's I don't know if the election year impacts it necessarily either way. I guess I wouldn't be surprised if that goes either direction. So again, another non-answer, but that's my opinion for what it's worth.
So Dale's going to take us away here.
Good morning, everyone out there. The last segment here that we're going to talk about is cash rents. Gary and Nick kind of laid out where we've been in farm incomes and what some projections are moving forward. We've kind of had a stable time of cash rents, more or less, with lower stable incomes, but the last year or two with higher incomes. Cash rent discussions have probably heated up a little bit on some changes in what we had due to the higher incomes. Just as a reminder to those out there, and we've had this slide up a lot over the years, but in Illinois, ERS would actually say about 50% of farmland is rented. From the FBFM records, we see a lot higher percentage of rented land than owned ground than what ERS shows. Illinois is one of the largest state that has the largest percentage, I should say, of rented ground. As you travel around the country, we do see a lot more owner-operated farmland than we do see in the Midwest and particularly Illinois. You can see in the central part of the state from the FBFM records, we would show about 14% is owned by operators. So that's owner-operated land. 42% is share rented, crop share rented from the traditional crop share rents and some modified crop share rents. 44% is cash rented. That includes fixed cash rents and variable cash rents. Over time, it has moved from share rent to cash rent. Probably 4 or 5 years ago now, I suppose, the Central Illinois group switched from the share rent being the largest percentage of leased ground to cash rent. That changes about 1% or so every year, every 2 years in terms of a little higher cash rent, a little lower share rent. And you can see in Northern Illinois, traditionally, that has had a higher percent cash rent over the years. In Southern Illinois is our larger percentage of owned ground. But generally, the shift has been over time from share rent to cash rents. So cash rents are becoming and have been becoming more important over time, and we've seen more interest in variable cash rents from the fixed cash rents. This slide shows from the NASS, National Agricultural Statistical Service. Every year they come out with an average cash rent for the states in the country, and you can see the 3 I states there, Iowa, Illinois, Indiana. For 2021, the average cash rent in Illinois was $227, $233 in Iowa, $200 in Indiana. That figure itself probably doesn't mean a lot because that's a blend of the whole state, and obviously that varies a lot among region and area in the state, quality soils and things like that. What is kind of interesting and important is just looking at the trends over time. We talk about that 2006 to 2014 period or so being a jump in high incomes due to a couple factors we've talked about, and you can see the response obviously in the increase in cash rents over that time. Pretty significant actually. In the last 3 or 4 years, we've had a drop in lower incomes, and we have seen kind of the cash rents generally come down, especially if they were at higher levels as we have had lower incomes from what we would expect. Last 3 or 4 years, then we've been kind of stable rents since 2016 or so, as incomes have kind of dropped and kind of leveled off a little bit. And so we've generally had, as I said, stable rents for the last 3 or 4 years. Every other year or so, generally the NASS does a county cash rent survey. This came out, the 2021 results in August. And you can see the average rents for the different counties in Illinois. As you move from the reddish counties, red shaded counties, to the darker green counties, you move from the lower average rents to the higher rents.
Labor growth, not regulation.
Obviously, that's going to follow the quality of the soils for the most part. And you can see the central Illinois area having the higher rents. and some in certain areas in northern Illinois. Both those areas have very good soils in certain areas, obviously higher yields than demanding higher rents. From this survey, the highest county was Macon County in 2021 with an average of $311. And the counties around that were in the high 200s, generally speaking. You get up in northern Illinois, the Carroll, Lee, Ogle, DeKalb counties have in the 250s and above range to 275, 260 or so in that area. So again, you can see the average rents. This provides another little barometer out there of what's going on. Again, this is kind of an average. You're going to have rents higher and lower than what these figures show right here, obviously. As we move into a discussion of variable cash rents, I'm going to go back a little bit and just mention that Gary, I think in August or so, put together early September, I think it was a FarmDoc daily that if these figures are a little hard to see, you can go on the FarmDoc website into the FarmDoc daily section, and you can see a publication that has this map in it with these average cash rents with some discussion about those. Also, as we move into some discussion on variable cash rents, it's going to point out there was a FarmDoc daily done in August that we'll be talking about here. So again, you can refer to that publication back on the FarmDoc website as we get into some discussion on leases and cash rents. So we'll spend a little bit of time on variable cash leases. Traditionally, probably over time, for the most part, going back 20, 30 years ago, if we had cash rents, they were mainly fixed cash rents, which basically means we had a fixed figure for the year. Those might be adjusted from year to year, but they didn't adjust within the year. We've had a lot more discussions and a lot more movement to variable leases instead of fixed cash rent leases, or still cash leases. But when we talk about variable leases, they adjust more to what the actual revenue is for the current year that the lease is under. And basically, some modification of the fixed cash rent lease just to bring in some terminology that adjusts the fixed lease to what actually the returns are for the current year. When you talk about the items in a variable cash lease, this basically in a simplest form, we're talking about kind of having a minimum or a base cash rent lease, a base cash rent amount, and adjusting that if returns are above a certain factor. So that would include then an additional payment as a percentage of the gross crop returns if that exceeds a minimum cash rent based on a factor, based on a formula, which might be a rent factor times crop revenue. One item to point out that this base or minimum cash rent figure in a variable lease is very important in regards to FSA, the FSA office, and them determining that it is a cash rent lease instead of a crop share lease. So you do want to have some kind of minimum rent in there or a base rent to satisfy the requirement that it is a cash rent lease for FSA purposes. Again, as we look at that first statement there, it kind of points out the items that need to be negotiated, the minimum cash rent figure or base rent, the rent factor, which we'll talk about here in a little bit, that's used, and then also the determination of what crop revenue is. Crop revenue is probably, for the most part, the simpler item to figure out there. Basically, it's usually the actual farm yield. It may be a county yield average, but usually the farm yield times the market price. The market price can be determined a number of different ways. Typically, it might be a monthly or weekly price from a local elevator from, say, March to October, March to November, or maybe a longer period than that. And then that's simply those two multiplied that times each other to get kind of whatever gross revenue figure is for the year. As far as the minimum rent figures, these are just some suggestions we may throw out there for the different areas of the state. You can see we've got kind of a minimum or base rent of $188 an acre for the northern part, $200 an acre for Central Illinois on the better ground, $160 for Central Illinois on the lower quality soils, and maybe something of $80 per acre in Southern Illinois. Again, these are a negotiable item. I think a lot of times we see these higher than these amounts, maybe quite a bit higher than these amounts. that has to be an item that, from an operator standpoint, especially if you get that too high, and I've seen this a lot where they are very high figures, really doesn't help you much in a down year from the operator standpoint, and protecting that low income year. Obviously, it supports the landlord when that happens, but again, that's an item that needs to be negotiated for the protection of both sides. A rent factor, what we're showing here then, and when we talk about rent factor, that's just basically a percentage of what the gross would be to determine what your final rent figure is. The figures or percentages we're showing here show what the rent factors would be for the 3 different areas of the state that we have divided there based on what we've seen actual cash rents been over time. So if we take what the cash rents have been from some of the record information we see, divide that by our gross crop returns, what corn and soybeans has grossed over time, just divide that out, and then over a time period, over an extended time period, is what the average percentage has been. And you can see for northern and central Illinois, they've basically been the same. 32% for corn, 43% for soybeans. For southern Illinois, it's been 38% and 48%. Again, so that rent factor is what over time, if we take the actual cash rents, fixed cash rents over time, or actual cash rents divided by our gross, what that percentage would be. So that'd be kind of the starting point for determining that rent factor. This slide is interesting in a number of ways. This simply shows since 2000 through 2020 on Central Illinois grain farms, higher quality soils for corn. If we look at what an average cash rent has been over time, and that's the red line going across there, and you can see what the per acre figure dollar amounts are. And then if we take the gross for each year times 32%, or that rent factor, that's the blue line, what that cash rent figure would be for each year based on kind of a variable rent, comparing that kind of more to a fixed cash rent. And I will say, Gary, I believe in this variable rent figure, we don't have a base in here. So this goes lower than maybe what would it be if you had some kind of basis in there. Then the bottom part of this shows simply the difference between the two cash rents for each year, the variable and kind of the average cash rent. And that difference there is variable less the cash rent figure. What's interesting to note, most years, the variable rent would actually, as far as the number of years, I think these count these up, about 14 out of these 21 years, the variable rent was actually a little less than what the average cash rent is. Where the variable rent really kicks up is when you have those high income years that happen every once in a while, where you hit both prices and yields especially. And you can see, for example, in 2008 and 2011 are very good examples that those years when we had market adjustments that caused high gross returns, the variable rent yielded quite a bit more to the landlord than what the fixed cash rent. The average cash rents, probably more fixed cash rents, they adjust slowly more over time, and that's kind of what this demonstrates. Now, over time, these are going to be pretty equal when you add the 21 years up or so, but it's just the fluctuation from year to year that responds to what actual returns are for that year. It's a very interesting slide that was put together there. Just a simple calculation or a simple example of some kind of variable cash rent. In this example, if we have a minimum rent factor of $200, a minimum rent of $200 per acre, a rent factor for corn of 32%, for soybeans 43%, and on a 50-50 corn-soybean rotation type farm, we'll see what, using kind of projected prices and yields, what we might see in rents. Down below here, we just simply do the math, 220 bushels per acre times 450, which we're saying Gary is saying what we're using in his budgets, gives you $990 gross per acre for corn times a rent factor of 32% times half the acres in corn, gives you $150, $158 per acre as far as the corn contribution to the cash rent. Doing the same thing for soybeans, 69 bushel per acre times 1235 gives you 852 gross times 43%. Times half of your acre is 183. Add them together, you've got a figure of a $341 per acre cash rent. Take the higher of the cash rent of our minimum rent. Obviously, the 341 is higher than the minimum rent in this example of $200, so that would be your cash rent. Again, this is kind of a simple example of how some type of variable rent would work. There's all types of different variable cash rent formulas out there. This is just one example that we use to kind of demonstrate that. Some advantages and disadvantages of a variable rent over a fixed cash rent. Obviously, the variable rent adjusts to the current market conditions, what the yield and prices are for the current year. So that's going to vary more with the returns. Theoretically, there should be less need to negotiate rents from year to year because this type of lease should adjust to what the returns have been. And that's generally true. The disadvantages when you start out with one of these, we do have these terms that we talked about that you have to negotiate, that being what a minimum or base rent is, what your rent factor is, the percentage of the gross that we're talking about, and then how that gross is figured. But if you can kind of work through those negotiations, we do see more of these variable rents coming into play. Again, they adjust to the factors for the year, plus you don't have to go back and kind of adjust that fixed rent every year necessarily and have those discussions. That's the idea anyway. So with that, I will turn it back over to Todd to give us a update on some of the things coming up down the road. Then we'll get into some of the questions.
You bet we'll get some of those. We'll get a couple of questions answered here too, but let's first review what the upcoming webinars are. And 2 have been added. So if you signed up early on, you were not expecting one next week or the following week. We've added to those. Bob Ray will be here next week, along with Brad Zwilling and Krista Swanson. They'll talk about some of the tax changes in agriculture, and they're important. You'll make sure you'll want to be here for that one so that you can understand what your taxes might look like when you go to pay them for the 2021 year. That'll come up next Thursday at 11 o'clock. And then on the 28th, that also is Thursday, Gary Schnitkey will be back along with Bruce Sherrick, and they'll talk about farmland markets and some of the factors that have been affecting them. Again, we would like to thank our sponsors for the day. They include TIAA, the Center for Farmland Research, along with Compere Financial, Corteva Agri-Sciences, Farm Credit Illinois, the Illinois Corn Growers, and the Illinois Soybean Association, along with FS Growmark, and the Gardner Ag Policy Center here on campus, along with the Department of ACE and the College of Agricultural, Consumer, and Environmental Sciences. And one final note, if you're trying to find all of these webinars in an archive, the series of 9, you can do that. You'll see down there in the bottom right-hand corner, it says YouTube. It's pretty simple. You might want to go bookmark this right away. youtube.com/farmdoc video. Not only will you see the current webinars, this series that is, but you'll see previous ones, and also some of the 5-minute farm docs that the crop scientists and the ag economists do here on campus. So be sure to visit that website. Again, that's down in the right-hand corner, youtube.com/farmdoc video. It's easy to find. Thanks to Jim Baltz, who's behind the wheel today. We appreciate him taking the time with us. Now let's answer some of those questions that you've been asking over the last 40 minutes or 50 minutes or so. I think I'll turn it back over to you. Gary, which one do you want to take on first?
So we have several questions here. We'll start with the easiest and then work our way up. So how much are your non-land costs for an acre of soybeans? We are projecting for 2021 $413 an acre of non-land cost for soybeans. That happens to be up from $371 from the year before or this year. So we're projecting a $43 increase in soybean cost, and that compares to a $70 increase in corn cost. And again, the reason why corn is going up more is because of the nitrogen fertilizer component. And again, that is going to be critical as we know costs are going up, and we're going to just see how see where those fertilizer costs and nitrogen break out.
Gary, I might just mention real quickly, in regard to that question, and you do have probably 3 or 4 times a year, Gary updates budgets on the FarmDoc site. And this information is available if you go to the management section in FarmDoc, and then in budgets, Gary has both his current budgets, which has 21 and 22, also another publication on historical returns for different areas of state for corn and soybean. And I find those very useful at times. So those are available on the FarmDoc website in the management section.
Yeah, I may jump in here real quick too, Dale, just so everybody understands. There are 2 sites. The one you see there, farmdocdaily.illinois.edu, and then there's farmdoc.illinois.edu, and that's where you're going to find this. It's the FarmDoc site is kind of the back end site, relatively speaking, but it has all the information that you're looking for to do all the calculators and these kinds of spreadsheets and some of the other updates. So you'll need to go to farmdoc.illinois.edu to find that information. One other note, Gary, before you answer the next question, those who are wanting to know if they can get these slides from somewhere, you already have access to them. They're in the gray boxes. So look under handouts and you can just download. There are 3 things there. The audio trouble you can dismiss, and then the other 2 PDFs are the same. It's just a matter of whether you want 2 slides on a page or 6 slides on a page. Gary, back to you.
So this is the next question. Is the crop share lease fair to both operator and landowner versus a variable cash rent lease? And I would answer the question that I would say the crop share lease is the best way to share returns and risk between the farmer and the landowner. And the advantage that the crop share has over the variable cash rent is that costs are included, the seed, fertilizer, and chemical costs, and also the government payments, which, the ad hoc payments, we did not build that into the variable cash lease. And if you look over time, the share rent lease has equaled our average cash rents over time. So over time, you'll see a lot more variability in share rents, but they equal the cash rent, and you don't have to go through that negotiation every year. We've also seen a movement away. Dale thought about this for a long time. What do you want?
Yeah, I would totally agree. When we get the question about, I want to be fair to both parties, and we kind of chuckle a little bit and say, we'll just go back to a crop share lease. Now, that being said, we realize a lot of landlords are not interested in marketing grain and paying expenses and things, and want some easier way of doing that. And that's kind of where we went to the fixed cash rents. And then if they're open to, if the landlord's open to having some risk involved, sharing in good times and bad, modifying that fixed cash rent to a variable cash rent. So that's kind of where that type of lease plays its role there. But if you're looking at adjusting accordingly to what's happening every year, and both parties are open to marketing grain, paying their half of the expenses or whatever, obviously the crop share lease still has a place. And there's some adjustments to the traditional crop share lease that have taken effect over time too. But yeah, that's still a viable lease.
Yeah. So here's will the prospects of higher interest rates impact rent prices? So I'll start there, and anybody can add to that they want to. Well, first off, I'm not sure interest rates are going to increase. We know that we have inflationary pressures, and this time around, though, your standard theory would say there's a real rate of interest, and you add on to it a inflation premium. Well, this time maybe the nominal rates stay the same, but we just drive our real rates down, which we'll see where all that happens. I'm not as convinced as that interest rates are going to increase, but again, that's looking at the future. However, even if they do, I would not expect that to have much immediate impact on cash rents, simply because interest rates are a low proportion of total cost on farms. Over time, it could have a larger impact on cash rents because as interest rates increase, you would expect to see all our cost increase. I personally would expect that interest rate increase to have more impact on land prices. And again, our land prices, you can make the argument we have high land prices not only because of high returns to farming, but also because of the low interest rates. Nick?
I don't think I'd disagree with anything Gary said. We've, I guess the other way you could approach it would be from sort of an asset pricing picture. And so if an interest rate is kind of your general measure of opportunity cost, there could be arguments that there would be impacts on cash rents associated with land. But I think rising interest rates effects would probably be offset by the drop in land values, and what we might see is, ultimately not much of a change in cash rents based on those two factors.
So we'll ask Nick, so is inflation a transitory thing, or are we in it for a long run?
I don't know. There's a lot of economists I've seen snarky comments on Twitter and all these other forums we now have to share information with each other. How the public's misuse of the word inflation and how higher prices today doesn't necessarily indicate inflation, which is a longer term measure. But and I'll be one that misuses the concept of inflation and just say that I know that our expenses have all gone up. So again, I think the question is it due to supply chain issues that will eventually sort themselves out, or what component of this is actually longer term? And again, all I have is non-answers today.
All right. Well, with that, how do you incorporate subsidies into a variable rent, especially market facilitation program payments? You could put those into our rent formulas. You would actually probably then have to think a little bit about lowering the rent factors if you want them to equal over time. You could put those in there. The issue, honestly, that you have with putting them in there is writing a lease where you say we're going to put payments in here that no one knows are going to happen. The ad hoc payments are ad hoc because there's no legislation that says that they're going to exist until they exist. Here's a question, and we're going to have to think about this. Strangely, your graph of cash rents and farmer returns above land costs was a random scattershot, and yet net returns are also into that affect cash. Any comments on the interrelationship between cash rents, net returns, and land values? All right. So we're thinking here, this is a good question.
Well, historically, there's a pretty strong relationship between cash rents and land values.
Yeah.
I would say that there have been periods historically where those relationships have broken down from what we might expect. The farm crisis of the 80s was one of them. For the opposite reason of what I would say is maybe another period where that's broken down a bit because we have such extremely low interest rates. We might expect cash rents or land values to be even larger than we do in practice today because of those low rates. So I think there is a pretty strong relationship, though, in kind of normal, typical times between those two factors. And then cash rents and returns, I think it's just a little bit harder to see in a picture because of the slow adjustment and the lag that we see in cash rents. So, returns obviously can vary pretty dramatically year to year, and cash rent contracts are not even necessarily all renegotiated every year. So we've got a combination of probably longer term leases and just overall stickiness in how those rents adjust in both directions. It really takes, I would say, a period of at least 3 to 5 years before we really see a change in trends for cash rents due to income fluctuations.
So with that, we are coming down to the end of our webinar. We appreciate your time.
We do indeed. Thank you, Gary. I appreciate that you and Dale and Nick have all been here on hand with us, and as well for everybody who has been watching the webinar. Again, just a reminder that you can find these online under webinars if you look at the FarmDoc Daily website at farmdocdaily.illinois.edu. If you want to bookmark that YouTube video site, youtube.com/farmdocvideo, that's a quick and easy way to find them as well. I do want to take time to thank Jim Baltz, who's behind the scenes each and every time we do these webinars as well. Jim does a great job of making sure that we're on track and that things look fantastic, and reminds me sometimes of the things I need to do. Again, to thank our sponsors as well, Compeer Financial, TIA, Center for Farmland Research, Corteva Agri-Sciences, Farm Credit Illinois, the Soybean Association in the state, the Corn Growers in the state, FS Grow Mark, the Department of Agricultural and Consumer Economics. We simply call that ACE here on campus usually. And of course, the Gardner Agriculture Policy Program, that and TIA, Center for Farmland Research, are both in the department. And you can look them up. Again, thanks to Gary Schnitkey and Nick Paulson and Dale Lattz. I'm University of Illinois Extension's Todd Gleason, wishing you the best of days.